Mr. Birla, Mr. Bhasin, Ms. Kochar, Mr. Didar Singh, Mr. Tripathi, distinguished bankers and business people, members of media, and friends. Let me start with two statements. The first is the deep sympathy that we have for our brothers and sisters in Jammu and Kashmir who are facing a devastating natural disaster. I want to assure them that the Reserve Bank will work with banks and other financial institutions to restore financial normalcy to the state at the soonest possible. Second, my colleagues and I have decided that we will try and make the following public announcement every time we speak, which is neither the Reserve Bank nor I solicit money from the public via emails, social media, or any other medium. This is important because I think increasingly the downside of digital is the access it gives to many people, and many people receive unsolicited offers, typically offering a large sum of money in exchange for an upfront fee to handle expenses. I think anybody receiving such an offer, no matter where it comes from, should understand if people want to give you so much money, why do they need an upfront fee in the first place? And use logic to dismiss such offers. But unfortunately, these are proliferating, and it's important we make the point that certainly we don't solicit such offers, and typically such offers are fake. Let me talk today about 5 different things. I'm going to talk first about the macroeconomy, then talk about changes in the banking sector, some of which you've already heard and seen discussed. I want to talk about developments in financial inclusion, and finally give you a sense of some recent regulatory decisions that have been discussed in the media, and end with a summary. So where are we in the economy? I think if you look outside India, you see a hesitant world economy still. I mean, the US has been picking up a strong second quarter, but after a very weak, in fact, first quarter with negative growth. We are probably reaching closer to the initiation of interest rate increases in the United States. Probably a long time still for Japan and the Euro area. And so there will be differentiated situations across the world, which may be a blessing, may create its own sources of turmoil as exchange rates move significantly differently based on who starts first and who starts later. In the short run, lower oil prices are helping consuming countries like us. Typically, a lower oil price means a lower current account deficit, lower oil subsidies, and lower inflation. We need to seize this moment to eliminate diesel subsidies completely. We can, of course, wait, but the moment may leave us, and we may be back to subsidizing. So we should take this moment to eliminate diesel subsidies as soon as possible. There are, of course, significant geopolitical risks. The Ukraine, the Middle East, and the worry is low oil prices may be a temporary phenomenon, I don't know. Certainly low global demand is helping. It's something that we shouldn't take for granted given the risks in the economy, in the global economy. Turning to the domestic front, I think the single biggest development of the last few months is the emergence of a stable government at the center, which certainly makes us stand out relative to our emerging market peers. The data on Friday suggested the recovery is still uneven, but it is, in my view, a recovery from the fairly low levels of growth we had reached. We saw on Friday that capital goods production came down once again, Durable goods consumption, the production of durable goods, durable consumption goods has still not picked up. But of course, we've seen fairly strong auto sales over the last few months, suggesting that perhaps that may augur better consumption numbers going forward. The monsoon has strengthened once again and is better than what was initially thought. Exports have been strong. So what remains is we need investment growth to pick up. And of course, when you look at investment growth, you also look at credit numbers. Credit numbers haven't picked up strongly as yet. Part of the reason may be that large corporations are also using the financial markets. Bond issuances have been significant over the last few months. ECBs have been an important factor. So they may be going outside. When we look at the overall resources, it hasn't fallen since last year, the overall resource use. But of course, it hasn't picked up strongly either, which suggests that investment is still awaited, and I hope it is coming soon as industry gains confidence and starts putting assets into the ground. Inflation is coming down. That was the news on Friday, and this is consistent with our forecasts, and I'm glad that it's staying with our forecast. The bottom line, macro indicators are improving, but still have some way to go before we can declare that we are out of the woods. I'm hopeful that it's only a matter of time. Let me come from the macroeconomy to the changes in the banking sector. There are tremendous changes, including the technological changes that we've been talking about this morning. We licensed 2 new universal banks, and I'm told that they're well on their way to recruiting staff, to moving into full-fledged banking structure. We've put out papers for discussion on payment banks and small banks. We've got comments back. In the next few weeks, we will put out a final paper asking for applications and delineating the final contours of these banks. We've also licensed a large number of prepaid instrument providers, and they're also adding to the mix in terms of new financial institutions that are participating in the sector. One of the big new developments is that mobiles and banks are coming together finally, mobile companies and banks in alliances using the USSD technology. I have to mention that the National Unified USSD platform went live on August 28th with 30 banks and 11 telecom companies. In 3 days, it processed 25,000 transactions. This is small, but it's a beginning, and I have no doubt that it'll grow in an explosive way. So I'm glad that finally this is taking off, and we have to make every endeavor to make sure it increases. We have liberalized the criteria for business correspondence. NBFCs can now serve as business correspondents, and the distance criteria has been eliminated. This offers banks an opportunity, but which has to be handled with care. That you have to take responsibility for the kinds of business correspondence you now put in place, but you have much greater freedom than you had earlier. As I said, large firms are using markets and external borrowing in a bigger way today. This is a necessary and welcome focus. It happens in every country. Over time, large banks migrate away from the banking system to using markets. And the problem in India is it hasn't happened to the extent that in fact it should, given the vibrancy of our financial markets. What does that mean then for banks in terms of business? It means that since everybody's competing for the remaining large firms, you have to go to the areas of the economy which are less serviced, which means micro, small, medium enterprise. Certainly credit to this sector has been growing at a healthy pace this year, but it needs more. And I'm hopeful that this will become a new challenge for the banks. We ourselves are trying to facilitate a receivables exchange, it's real name trade receivable discounting system, whereby small and medium companies can rediscount the receivables they have on large companies with banks and thereby get working capital finance, while banks take on the credit risk of the large companies. The system is going to start being put in place. We will make whatever legislative changes are necessary to put this on a firm footing, but it's very important that the banks participate in this and perhaps devolve some of the credit that they allocate to large companies now to buying the bills that small companies present on these large companies. That would help credit flow to the small and medium sector, which is very important. On the retail side, there was some talk of the gyro system. The Bharat bill payment system is now, at least the conceptual structures in place, and we think that this will now be something which will be put out, and it's something that banks can participate in, and I have no doubt we can have the idea of anybody, anywhere, making a payment to anybody elsewhere, not just to utilities, through the Bharat bill payment system. So that's something else which is certainly the structure, the framework, the design is very much in place, and now we need to create the institutions that will make that possible. Now, those are two possible areas, but the third very important area where banks are needed is, of course, infrastructure. As the economy starts growing again and these trillions of dollars of infrastructure projects come up, we need to find ways to finance them. And fortunately or unfortunately, it has to be the banks, because as of now, we don't have other financing structures. Now, we have to take the lessons, or draw the lessons from our previous foray into infrastructure, and to understand that there are certain areas where we need to do better. First off, project evaluation. We need better evaluation using in-house skills, not intermediaries. I think one of the problems that has emerged in recent years and in recent scandals is the fact that evaluation has been outsourced. Evaluation is so central to banking, it's impossible to outsource it. It has to be brought back in-house and competencies generated. We have to move towards engaged, informed banking and not banking driven by outside intermediaries and middlemen. But going from that evaluation, we also need better structuring. We need more genuine equity brought in by the promoters, not leveraged equity or fake equity which disappears after an initial few months. We need longer payback structures created by the banks, and we've changed our regulations to allow for the possibility of 520, 525 kinds of structures, where you will have the possibility of getting paid back over a longer period and refinancing in the intermediate. So banks have the flexibility now that they didn't have earlier, and we won't make the mistakes that we made earlier with much shorter paybacks. We also have relaxed the preemptions if you raise money long-term, and I'm glad to see that ICICI has also already raised long-term funds in this scheme. Anything over 7 years, you get exemptions from CRR, SLR, as well as priority sector, so long as it's invested in infrastructure or affordable housing. So better structuring would be very important to ensure that we manage the risks in infrastructure. Of course, all this is taking into account that we reduce the risks on the real side, which had increased tremendously over the last few years. Not just demand risk, which was there because of the slowdown in the economy, but also governance risk because permissions weren't being granted, licenses weren't, clearances weren't being obtained. Hopefully that is diminished, but we also have to do what we need to do on the financial side. The third element of better structuring is better monitoring. Early recognition of project distress or potentially of diversion of funds, quick and coordinated action amongst the banks to stop that and effective project restructuring or reconstruction. And we're trying to offer the help we can from the RBI with our large loan database and the new joint lending forum that we've suggested banks form. We're also trying to help by giving ARCs better incentives to collect, and over time bringing more players into the ARC business. That is something that would be useful in making sure this happens. And finally, if the project works out, gets constructed on time, we need to afford better ways for you to be able to sell loans post-construction. One of the elements that we've added is the ability for you to enhance credit for some of these structures through liquidity facilities, etc. But I also think the whole set of new structures the government is creating, infrastructure development funds, etc., will be available to buy, and we also want to encourage foreign investors to buy at that point constructed loans to long-term projects where they have a low-risk profile and can be good fixed income assets. Now, one of the biggest concerns, of course, in the infrastructure space is the legacy of non-performing assets from the past, which certainly clog some of your books. And, you know, we can spend a long time deciding or discussing what was the reason for this. Clearly, public sector banks went in a bigger way into infrastructure. The bad economy, some elements of poor structuring, and the slowdown in government action contributed to the build-up in non-performing assets. But as you all know, there are also allegations of malfeasance. The syndicate bank case, I don't want to comment on the details, but certainly is a suggestion that there could be malfeasance. So, as was said earlier in this forum by Mr. Tripathi, the public sector system is a system which has tremendous resources, lots of very good people, but we do need to fully benefit from the strengths of the system by rooting out the bad apples, the bad practices, and the weak capabilities in the system. We have commissioned a report, the PJ Nayak Committee report on governance reforms, not just in public sector banks, but also in the private sector banks. But there are a number of important suggestions that we have sent to the government on what could be done. Clearly, splitting the role of chairman and CEO would allow for one layer of oversight over public sector management, lengthening CEO tenures so that they have a substantial amount of time to undertake strategic actions is extremely important. We have to change the appointment process and expand the talent pool for management and boards of public sector banks. It has to be much more transparent and driven by people with strong capabilities. We have to strengthen board oversight and powers. The boards have to be empowered, and they have to be able to hold management accountable. So we have to work on improving the quality as well as the effectiveness of bank boards. Some of the sort of problems in bank boards stem from regulatory reasons. We ask banks to do an enormous amount, and we have to focus banks, boards, on doing important stuff rather than box-ticking exercises. And so that certainly is something we're going to look at. And finally, I mean, we're competing for bank board members in a national pool, maybe even a global pool. we can't undercompensate bank board members but compensate everybody else and ask bank board members to take on an enormous amount of risk. I think we need to look at bank board compensation also to make sure we get the right people in there. So apart from all this, I mean, many of you are aware of the challenges that you have. Human resource development is a central challenge, especially given the hiring freezes that were in place in public sector banks for some time. There is a middle management gap, and we have to find ways to fill it through hiring, maybe even lateral hiring, through appropriate pay, through incentives, and through skill building. And certainly, we at the Reserve Bank would be happy to help where we can. In all this, I think the use of technology to improve efficiencies, to cut costs, is also going to be extremely important. And finally, something that was mentioned again on this forum, public sector banks have to have the independence to make commercial decisions, which means, I mean, by all means, government mandates may be there. The government obviously has many imperatives, social, etc. But when those mandates exist, they should be backed by financial payments. You can't give a mandate and not fund it. After all, the public sector banks also have private shareholdings and are not any longer an extension of the government. They should be seen as independent entities. By all means, there to undertake social actions when necessary, but those mandates should be backed by financial payments. And after all, it's when you make those financial payments that you realize the true cost to society of the mandate that you impose on the bank. For example, if you want banks to undertake the business of making transfers, you have to set aside compensation payments for them to make the transfer, so it makes it worthwhile for them to go out and open the bank accounts that are necessary to make those transfers. Let me turn to develop. So we're taking up some of these issues. We have a constant dialogue with the government. We're discussing some of these issues on governance, improvement, etc. And let's see how much progress the government and the Reserve Bank can make. Turning next to developments in financial inclusion, of course, the biggest recent development is the Pradhan Mantri Jan Dhan Yojana. Clearly, universal financial access has to be a national priority, and it is certainly something that is well worth for the government to push. If every Indian household is connected to the financial system, you can get a tremendous increase in financial savings. Now, the savings share of rural India is now 10%, which is way too low compared to the GDP it generates. You can also get direct benefits transfers, which means less leakage in the process of providing government services, less price distortion. Today, you subsidize the price of kerosene, so kerosene actually is overused, misused sometimes. But instead, if you gave people transfers and directed it to the very, very poor who needed it, you wouldn't need to distort the price of kerosene, and therefore kerosene wouldn't be misused in many ways. It also leads to more empowerment, direct benefits transfer. If I have money as a poor person, I get respect. And that's much more than if somebody is told to service me and does it hesitantly. Also, it takes us towards, if everybody has bank accounts, the fact that they have cards, and this is something that the Prime Minister emphasized, gives them a sense of authority, and also moves us towards what we, I don't like these words, but they reflect pretty much what we're trying to do. They move us towards a less cash economy, which is not cashless. We can't do away with cash, but we can use less cash, and that's the RuPay card would move us towards that. So this is a good scheme. It is a worthwhile scheme. And if we can bring the 75 million or 7.5 crore excluded households into the system, it will enable us to do a tremendous amount. But when we roll out the scheme, we have to make sure it doesn't go off track. The target is universality, not just speed or numbers. We need everybody in the system. We need them to get access. The system is going to be a waste if what we do is generate a whole set of duplicate accounts. Same guys who already have accounts in the cities, we give them new accounts. It's going to be a waste if we don't have full coverage. If those 75 million households are not the households who get accounts, but if somebody else gets accounts. It's going to be a waste if the accounts are not used. They just open, they languish. Many of these people who are coming to the system for the first time, we're making a first impression on them. If we don't make a good first impression, they will stay out of the system, and next time they won't come. This time they're being enticed with a few benefits. But if we entice them and then basically show them no actual value, they're not going to come back for a long time. So let us make sure it works. And the Reserve Bank will work with the banks to see what we can do as we go along to improve the effectiveness of the scheme. But I want to add two elements to any scheme of financial inclusion. Equally important is customer grievance handling, especially for the very poor. They're the guys who can be taken most easily for a ride. They're the guys whose trust can be misused. And so it's very important, as you hire these business correspondents, that you maintain control over them, that you make sure that this doesn't become a source of abuse or misuse. And we've put out a code of conduct for comment, but we want to ensure that at least the spirit of the code of conduct is in fact something that banks stay by. And I would emphasize again, as you roll this out, I know there are tremendous pressures on you, but it's important it be done right. It's important that it be done with control and without losing control of the business correspondents that you hire. Second aspect is customer literacy. Now, customer literacy certainly implies camps to tell people what a bank account is, to tell people what interest rate they will earn, how to use their card, etc. But it is more than that. It's more than just handing out materials in a camp. It means closer engagement on inculcating savings, investment, and security habits, and even basic business sense. Of course, you may say, this is not my business as a bank. But ultimately, creating these strong relationships will pay back in a big way. And to the extent that you can involve NGOs, you can involve organizations like NABARD in going the whole hog and creating the relationship with the customers who are brought into the system to give them a much better sense of savings, investment, I think it will repay the country certainly manyfold over the years. And many of you are starting to see business models here, especially where you can use technology. And I think we should let 1,000 flowers bloom and share experiences over time. Now, finally, I would say in any system of financial inclusion, we have to recognize that many sectors in the economy get too little credit. There are many sectors that get very little credit. And the real solution to this is to develop the financial framework across the board. That is, we have to work on improving the institutions, the markets, the laws, the regulations, etc., so that everybody gets access to credit. What is less effective, I would say, are things like interest subventions. Often the solution that a state government or local government or central government thinks to the problem of too little credit is, let's offer another subvention. But subventions distort the price of credit and lead to misuse. One example of a distortion, NABARD has frequently pointed out that we subsidize crop loans in agriculture. But one of the biggest needs in agriculture is long-term investment. And farmers don't get long-term money, or they choose not to get long-term money because short-term money is subsidized. Crop loans are subsidized, but long-term investment money is not subsidized. This is a distortion, and it's created by changing the price of credit. Second, sort of unhelpful activities to waive loans. Instead of working on improving the incomes of borrowers through better governance, through improving access to markets, and through providing public facilities like irrigation. I think the single important lesson from loan waivers we have to take away is every time a loan waiver is done, it disrupts the process of credit. And in fact, hurts the beneficiaries by shrinking access to credit. I'm not talking about situations where you have a calamity and there's some need for loan restructuring. I'm talking about situations where people who don't need loan restructurings are in fact given this. The two periods when we saw a substantial fall off in agricultural credit, 1989-90 after a massive set of loan waivers, and 2009 again after another set of loan waivers. This is not healthy for the system. It disrupts the credit culture. We keep saying this. It is important that the political establishment understand the best way to offer credit to concerned people is by improving the credit culture and the credit framework. And the final thing is selecting special sectors for easier credit. And clearly, we have priority sector norms to channel credit to certain sectors, and that there is certainly some thinking that has gone behind it. But we have to keep asking ourselves, why should some sectors get more easy credit than others? For example, we actually subsidize in the priority sector student loans for study abroad. Now, are students studying abroad, the most needy in the country, or is it most important to send students abroad? Now, this is something people have got used to. I'm not saying that this is a bad thing, but it is something that we should ask questions about. What categories come under priority sector? Let me end with two recent regulatory decisions that have created some debate, and I want to explain them. One was, of course, we used to mandate 5 free transactions per month at any ATM. So you could go to a bank which was different from your the bank where you had a bank account, and take money out from the ATM at that bank. Now, it was free to you, but it is not free to the bank at which you have an account. That bank has to pay the bank at which you took out the money for your transaction. And if you could do up to 5 such transactions, it could cost your bank between 75 and 100 rupees for those 5 transactions. Now, there is no such thing as a free lunch. That's something we forget sometimes. If your bank has to pay some other bank for those transactions, it means it has to collect it from somebody. And it collects it from somebody by increasing some other fees on the customers. It passes the cost back to the customers. Now, to the extent that everybody does 5 transactions free and everybody incurs the same cost, that cost is passed back to all the customers. You're neither better off nor worse off. You're just paying in a disguised way. Nobody knows what they're paying, but it's being paid for, because after all, the bank is going to give it back to you. But there are 2 distortions it creates. First, typically not everybody pays the same amount. What happens is the guys who are doing 5 transactions get the most from this, while the guys who are doing no transactions or 1 transaction, typically the people who don't have too much money, don't get the benefit of the subsidy. This becomes a subsidy which benefits those doing more transactions. It also distorts the number of transactions they do. They do more transactions because it is free. So the question we had is, should we mandate? The answer is not, we're not telling banks to charge fees. We are saying, should the RBI mandate such cross-subsidy? And second, should we also, in the process, subsidize the use of cash? Because by freeing up ATMs, we are forcing people, in a sense, or subsidizing people in the use of the cash. So what we decided was, it would be a partial and very measured withdrawal of the mandate in areas that are likely to be well served by the banks. We've reduced the number of free transactions from November to 3 in the 6 metro areas which have plenty of ATMs. This is not telling the banks you have to charge. It is telling the banks you can charge after 3 if you want. But if you like your customers a lot, don't want them to go away, or you have relatively few ATMs, you'll still continue subsidizing the ATM transaction by allowing it to be free. So what we've done essentially is allowed banks to make better business decisions and reduced the hidden subsidy, the hidden cross-subsidy, I should say, and made it more transparent. Second regulatory decision was we have mandated two-factor authentication for credit cards. Now, recently we have been, it has come to our notice that some firms are bypassing this and indeed clearing transactions abroad, and thereby contravening a number of rules that are on the books. We said, don't break the rules, and sent out a circular to this effect. And the immediate pushback was RBI is against innovation. These are wonderful firms doing wonderful things, and RBI is slowing the process of innovation. Let me first say that whatever the innovation, breaking the rules is not done. You have to follow the rules. And the rule of law, which many of the people who want innovation are also for, means that if we have a rule on the book, we don't allow it to be violated simply because the innovation is cool. We enforce our rules. Now, why did we go towards two-factor authentication? In fact, that itself is an innovation, and it has enhanced the peace of mind of a number of our people. Initially, it was a problem getting used to it. Do I have to punch in another number? Am I going to get a one-time password? It's a pain, but it certainly has improved the security of transactions. Let me give an example of a situation which is on my table every 2 weeks, because there's a poor lady whose credit card was stolen. She tried to contact her bank to report the credit card because that was required to stop the payment on her account. The bank line was busy. She couldn't get through, at least that's what she says. She went and filed a police complaint, but only the next day she managed to get through to the line and say, look, my credit card was stolen. And there were significant transactions done on that card in the meantime. Question is, who bears that cost? And certainly because she can't prove she tried to contact the bank has said, you bear the cost. And after some discussion, it's willing to share some of that cost. But the real problem in our society is we have people who are in many ways not trained to maintain security, and we may not have the same systems that we have in industrial countries. Sometimes the phone lines don't work. Sometimes they're busy. So in such an environment, should we have exactly the same rules that they have in the United States? And the point is that we need to adapt to the conditions in our environment. And sometimes those conditions require a different system. And so those who say, let's just take the innovation there and put it here, look at the totality of our environment, the culture that we're in, and think of how to do it. Now, can we do better, given this is a digital focused conference? Of course we can do better. And what we're trying to do is see how we can adapt to innovation to allow easy use for small value payments. So maybe we can think about reducing the need for a second authentication for low value payments, provided the card provider has systems to protect against misuse, and provided they will bear costs beyond a certain point if the card is misused. So we don't have this problem of the poor lady who's out a huge amount and who just can't bear those losses. And I get that problem on my desk every 3 weeks. So bottom line, we're not against innovation. We very much want the kind of innovation that was talked about. We just have to make sure that we work our way through it and get the innovations while containing risks in the system. After all, you trust us to keep a control over risk. We trust you to help us in doing that, and we need to work together to make that possible. So we're in the process of picking up growth. The macroeconomy is improving, even if the journey is likely to be bumpy. And it's going to be bumpy because the world economy is bumpy, and it's not going to be a smooth ride. Inflation is coming down, consistent with our forecasts, and I'm happy that is the case. We have many opportunities in the banking sector, but also some challenges which I've talked about. And we are working with the banking sector to make sure we can address those challenges even while allowing you maximum freedom to take advantage of those opportunities. And this is an extremely exciting time for banking in India. I'm glad many of you are here and will take advantage of what India has in store for us. Thank you.